EPK Capital presents Deep Dive on UnitedHealth Group. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host Alan. In this series we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about UnitedHealth Group. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. For decades, UnitedHealth Group was the undisputed king of healthcare, a titan of the Dow Jones Industrial Average, and a stock that seemed to only move in one direction, up. Its chart tells a story of incredible, multi-generational wealth creation. But in the last year, this giant has stumbled. The stock is having its worst year since the 2008 financial crisis, wiping out hundreds of billions of dollars in market value and leaving investors asking one critical question. On one side, the company is engulfed in a perfect storm of unprecedented crises. A massive cyber attack that crippled the nation's healthcare payment infrastructure, the tragic murder of a top executive, and a multi-pronged criminal and antitrust investigation by the US Department of Justice. On the other side, a powerful signal has emerged from the world's most famous investor. Warren Buffett's Berkshire Hathaway has just made a multi-billion-dollar bet on the company's recovery. Is this a generational buying opportunity to acquire a market leader at a historic discount? Or is it a classic value trap, with risks so profound that even the Oracle of Omaha might be wrong? In this deep dive, we will dissect every facet of UnitedHealth Group to provide a comprehensive, neutral analysis, deconstructing the behemoth, the UNH business model and promoters. To understand UnitedHealth Group, one must first appreciate its sheer scale. It is the largest healthcare company in the world by revenue and a heavyweight on the Fortune Global 500 list, ranking 8th in 2024. The company's empire is built upon two distinct but deeply interconnected engines, UnitedHealthcare and Optum. The two engines of a healthcare empire. UnitedHealthcare is the company's traditional insurance arm and its primary source of revenue. It generates income primarily through premiums paid by employers, individuals, and government programs like Medicare and Medicaid. This segment is a behemoth in its own right, serving an estimated 148 million people globally. It holds the largest market share in the US commercial insurance market and is the top player in Medicare Advantage, a privatized form of Medicare that has been a key growth driver for the company. In 2021 alone, premiums accounted for nearly $226.2 billion, or almost 79% of total revenues. Optum, formed in 2011, is the company's high-growth, high-margin health services arm. It represents a strategic pivot from simply financing healthcare to directly providing and managing it. Optum itself is divided into three powerful subsegments. Optum Health. This is the direct patient care division. It has quietly become the largest employer of physicians in the United States, with at least 90,000 employed or aligned doctors operating out of 2,200 locations. This is where UnitedHealth Group delivers healthcare services directly to patients, from primary care to specialized treatments. Optum Rx. This is the company's Pharmacy Benefit Manager, PBM. It manages prescription drug benefits for millions of people, processes pharmacy claims, negotiates drug prices, and operates large-scale mail-order pharmacies. Optum Insight. This is the data and technology backbone of the company and the broader healthcare industry. It provides sophisticated data analytics, payment processing, and other technology-enabled services. This division was significantly expanded through the controversial 2022 acquisition of Change Healthcare, the largest health payments platform in the US. The creation and rapid expansion of Optum was not merely a diversification play, it was a fundamental strategic shift. By integrating an insurer, UnitedHealthcare, with a massive provider of health services, Optum, the company created a closed-loop system. The insurance arm provides a vast, captive customer base for the services arm. This vertical integration allows UnitedHealth to control nearly every step of the patient journey, from the premium payment to the doctor's visit to the prescription fulfillment. This model has created a powerful competitive moat and a highly profitable enterprise, but it is this very structure that has now placed the company at the center of a major antitrust investigation by the Department of Justice. A legacy of growth by acquisition. UnitedHealth Group's history, which began with its founding as CharterMed in 1974 by Richard Burke, is a story of relentless growth fueled by strategic acquisitions. Key milestones include the 1995 acquisition of MetroHealth, combining the healthcare operations of Travelers and MetLife, the 2005 purchase of Pacificare Health Systems, and more recent multi-billion-dollar deals for DaVita Medical Group in 2019 and Change Healthcare in 2022. This aggressive acquisition strategy has allowed the company to consolidate market share, enter new markets, and build the integrated behemoth it is today. Leadership and ownership. The company's leadership is currently in a state of flux. Amid the recent turmoil, CEO Andrew Whitty stepped down for personal reasons in May 2025. He was replaced by Stephen Hemsley, a former CEO who led the company from 2006 to 2017, a period that included the creation of Optum and rapid growth. This move is widely seen as an attempt to bring in a seasoned, trusted hand to navigate the current crisis. The company's ownership is dominated by the world's largest financial institutions. Over 90% of its shares are held by institutional investors, with the top holders being Vanguard, BlackRock, and State Street. This high level of institutional ownership is a double-edged sword. On one hand, it signals confidence from the smart money. However, a closer look reveals that much of this ownership is passive, tied to the stock's significant weighting in major indices like the S&P 500 and the Dow Jones Industrial Average. This means a crisis at UnitedHealth is not just a problem for one company. It is a portfolio problem for millions of retirement accounts. This creates immense pressure on the company to stabilize, but it also means that if these major institutions were to lose faith, the selling pressure could be catastrophic. The financial vitals, a decade under the microscope. For a decade, UnitedHealth Group's financial performance was a model of consistency and strength, cementing its status as a blue-chip stalwart. The growth machine. An examination of the company's 10-year financial history reveals a relentless growth trajectory. Revenue soared from approximately $157 billion in 2015 to over $400 billion by 2024, a testament to its successful strategy of acquisition and organic expansion. This top-line growth was consistently translated into bottom-line profit, with net income and earnings per share marching steadily upward over the same period, rewarding long-term shareholders handsomely. Profitability under siege. However, this pristine track record has recently been broken. While historically strong, the company's operating and net profit margins have come under significant pressure, a key factor driving the stock's dramatic decline. The primary cause is a surge in medical costs, particularly within the crucial Medicare Advantage business. Higher than expected utilization of healthcare services by members has forced the company to pay out more in claims, compressing the profitability of its largest business segment. Balance sheet health. Despite the operational headwinds, the company's balance sheet remains solid. As of the most recent data, total debt stands at a significant but manageable level of around $79 billion, with a debt-to-equity ratio in the range of 75 to 80%. Crucially, this debt is well covered by the company's robust operating cash flow, and its interest coverage ratio is strong, indicating that UnitedHealth is not in immediate financial distress and has the resources to navigate the current challenges. Shareholder returns. UnitedHealth has a strong history of returning capital to shareholders. The company initiated a quarterly dividend in 2010 and has increased its payout every single year since, putting it firmly on the path to becoming a coveted dividend aristocrat. The dividend has grown dramatically, from an initial $0.125 per share in 2010 to a recent quarterly payment of $2.21 per share, reflecting the company's long-term earnings power and commitment to its investors. Anatomy of the 2024-2025 crash. Zooming in on the last 2 years, however, shows a dramatically different picture. After reaching an all-time high near $630 in late 2024, the stock entered a steep and punishing decline, ultimately collapsing to a 52-week low of around $230 in 2025 too. Currently, the stock is trading within a falling trend channel, a technical pattern that signals persistent pessimism and selling pressure among investors. Key levels and indicators. In the current environment, traders and investors are closely watching several key technical levels and indicators. Support and resistance. The most critical level of support is near the recent lows, around $240. A decisive break below this level could signal another significant leg down for the stock. On the upside, a major zone of resistance lies at $460. The stock would need to overcome this level to signal a true reversal of the downtrend. In the shorter term, several minor pivot points and resistance levels exist in the $290 to $320 range. Relative Strength Index, RSI. The 14-day RSI, a momentum indicator, currently stands at approximately 53. This reading is considered neutral, suggesting the stock is neither overbought nor oversold after its recent bounce from the lows. It is important to note that prior to this bounce, the RSI had plunged to levels not seen in decades, indicating the stock was in a deeply oversold condition. Moving averages. The technical picture from moving averages is mixed. Short-term averages, like the 5-day and 20-day, are flashing conflicting signals as the stock attempts to stabilize. However, the longer-term 50-day, 100-day, and 200-day moving averages are all currently above the stock price, acting as levels of overhead resistance and confirming that the broader trend remains negative. The value investor's calculation, applying the Benjamin Graham formula. To determine if a stock is truly undervalued, many investors turn to the classic valuation methods, pioneered by Benjamin Graham, the father of value investing. His revised formula provides a straightforward way to estimate a stock's intrinsic value. Interpreting the result, the calculation yields an estimated intrinsic value of approximately $427 per share. Comparing this to the current market price of around $300.22, the Benjamin Graham formula suggests that UnitedHealth Group stock is significantly undervalued. This indicates a substantial margin of safety, a key concept for value investors, which provides a buffer against errors in judgment or further negative developments. It is crucial, however, to remember that this is just one valuation model, and its output is highly dependent on the growth rate assumption. It serves as a valuable tool, but not an infallible predictor. The great debate, the bull case versus the bear case. The sharp divergence between UnitedHealth's battered stock price and its calculated intrinsic value lies at the heart of the debate between bulls and bears. The bull thesis, the generational opportunity. Deeply undervalued. Bulls argue that the market has overreacted, punishing the stock far beyond what is justified by its current problems. The stock trades at a forward PE ratio of just 11 to 12 times earnings, well below its historical average of around 19. This valuation, supported by the Graham formula and discounted cash flow (DCF) analysis, which estimate the intrinsic value to be as high as $8.67, suggests a massive upside potential. The Buffett stamp of approval. The recent disclosure that Warren Buffett's Berkshire Hathaway acquired a $1.57 billion stake is a powerful vote of confidence. Buffett is renowned for buying great companies during periods of temporary trouble. His investment signals a belief that the company's long-term franchise remains intact and that the current issues are surmountable. Dominant and diversified market position. UnitedHealth's scale is a formidable competitive advantage. As the largest player in the industry, its diversified model, anchored by the powerful and growing Optum business, creates a durable moat that is exceptionally difficult for competitors to replicate. Optum's continued growth. The Optum segment remains a powerful long-term growth catalyst. By expanding into direct care delivery, pharmacy services, and health technology, Optum is moving the company into higher margin business lines that are less exposed to the regulatory pressures of the insurance industry. The bear thesis, the value trap. Unprecedented legal and regulatory risk. Bears contend that the market is correctly pricing in an existential threat. The company is facing a multi-front war with the Department of Justice, including an antitrust investigation that could challenge its entire business model and a separate criminal probe into its core Medicare Advantage billing practices. The potential for massive fines, government-mandated changes to its operations, or even a forced breakup of the company cannot be dismissed. Medicare Advantage margin. Collapse. The profitability of the company's most important growth engine is under severe pressure. A combination of rising medical costs and increased regulatory scrutiny on billing practices has crushed margins. There is no guarantee that profitability in this segment will ever return to historical levels, which would lead to permanently lower earnings power for the entire company. The Change Healthcare fallout, the catastrophic cyber attack on its Change Healthcare subsidiary, has created a cascade of devastating consequences. It has resulted in immense direct financial costs and reputational damage, and it has handed regulators a perfect example of the systemic risks posed by UnitedHealth's massive, vertically integrated structure. A mountain of negative headlines. Beyond these headline risks, the company faces a relentless barrage of lawsuits and negative press related to allegations of improper denial of care, anti-competitive behavior, and other controversial business practices. This ongoing storm erodes public trust and political goodwill, making the company an easy target for regulators and lawmakers. A litany of red flags, due diligence checklist. A thorough analysis requires a deeper look into the specific red flags that constitute the bear case. These are not minor issues. They strike at the core of the company's business model and its relationship with the government and the public. The legal quagmire, a deeper dive. The antitrust investigation. The DOJ's antitrust probe is focused on the very structure that has made UnitedHealth so successful, its vertical integration. Regulators are investigating whether the company leverages its massive insurance arm, UnitedHealthcare, to stifle competition and unfairly steer patients toward its own Optum-owned physician groups, pharmacies, and other services. An adverse outcome could force fundamental changes to how the company operates. The Medicare fraud. Upcoding. Investigation. This is perhaps the most serious threat. The government's criminal investigation centers on risk adjustment, the process by which Medicare Advantage plans are paid more for sicker patients. The allegation is that UnitedHealth systematically and illegally exaggerated patient diagnoses, a practice known as upcoding, to fraudulently extract billions of dollars in excess payments from the government. A criminal conviction could result in staggering fines and severe restrictions on its ability to participate in government programs. The cyber attack fallout. The February 2024 ransomware attack on Change Healthcare was a systemic event for the entire US healthcare industry. Because Change Healthcare's platform processes an enormous volume of claims and payments, the shutdown crippled the financial operations of hospitals, clinics, and pharmacies nationwide. The ongoing consequences for UnitedHealth include billions in costs to remediate the attack and provide emergency funding to providers, a flood of lawsuits from affected parties, and intense scrutiny from Congress and regulators over the national security risks posed by its market dominance. A pattern of controversy. These major crises exist within a broader context of controversial business practices that have attracted negative attention for years. A review of public records reveals a consistent pattern of allegations, including denial of care. Numerous lawsuits and investigations allege that the company uses proprietary algorithms and other methods to improperly deny necessary medical care to patients in order to boost profits. Anti-competitive practices. The company has been accused of using its market power as a PBM to squeeze independent pharmacies out of business and of forcing physician practices it acquires into illegal, non-compete agreements. Patient privacy violations and corrupt practices. Other documented issues include allegations of misusing patient data and instances of insider stock sales by executives during periods of crisis. Any one of these issues would be a major headwind for a large corporation. A DOJ antitrust probe is serious. A criminal fraud investigation is more serious. A catastrophic cyber attack on critical national infrastructure is a disaster. The key is to view these not as separate problems, but as a tangled, interconnected web of risk. The cyber attack strengthens the government's antitrust case. The upcoding allegations erode political support. The denial of care stories fuel public anger. This cumulative, multi-front battle creates a level of uncertainty that is far greater than the sum of its parts and makes predicting the company's future incredibly difficult. Conclusion: inflection point or point of no return. The analysis of UnitedHealth Group presents one of the starkest conflicts in the market today. On one hand, we have a corporate titan with immense scale, a powerful and growing services business in Optum, and a stock price that, by traditional metrics, appears deeply undervalued. It is a profile that has attracted the world's most successful value investor. On the other hand, we have a company facing what could be an existential threat from the highest levels of the US government, a core business line with collapsing profitability, and a reputation battered by a relentless storm of operational failures and controversy. Ultimately, the investment decision hinges on an assessment of these opposing forces and an individual's tolerance for profound uncertainty. For the bulls, the bet is that UnitedHealth's immense financial strength and market power will allow it to weather this storm, reach a manageable settlement with the government, fix its operational issues, and emerge stronger, making the current price a historic bargain. For the bears, the risks are simply too great. The potential for a government-mandated breakup, crippling fines, or a permanent impairment to its business model makes the stock uninvestable, no matter how cheap it appears on paper. The coming months will be critical. News from the Department of Justice and the company's progress in stabilizing its Medicare Advantage margins will be the key catalysts to watch. Whether UnitedHealth Group is at an inflection point or a point of no return is a decision every investor must weigh for themselves. The facts are on the table, and that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget to subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description.